Risk, behind the scenes is the credit markets and the shadow banking industry. So loans to commercial real estate from life insurance companies, hedge funds, investment funds, private equity, things like that. There's a lot of distressed assets there, but it's not putting a lot of pressure on most banks. Some banks are under pressure in their commercial portfolios. The residential market, is so real estate's hyper local. So every asset, every market, every city, street, place on that street, everything's different in every market. Some housing markets are red hot across the country and seeing multiple offers still and going in days. Some markets, are really falling off a cliff, and we're seeing values drop and inventories rise and days on markets rise and things like that. And to evaluate any market, the things that you want to know, the most important things are, let's just take residential, but you can, go with commercial as well. And transactions are down in commercial, in multifamily by 80%. So, the transactions have crashed in the commercial market and the residential market. Office and retail are almost dead. Multifamily is still transacting, but way off, levels. But for any market, what you want to know is how many properties are for sale, how long they've been on the market, how many properties are under contract, how long were they on the market, how many properties sold in the last 30, 60, 90 days, and how long were they on the market, and what did they sell for, ask price to settle price. So that's how you evaluate any market for any asset anywhere in the country. And that's how you can quickly know absorption rates, which is the key to a good market and knowing whether or not that's a good market to invest in. And, commercial is a little bit more nuanced than that, but that's all you need. Those four things in any residential market will tell you where you're at. And, they're very different all across the country. And even markets that are correcting, like Austin, Texas, Phoenix, Arizona, there's still even pockets in those markets that are still doing well. So it's just certain, price points and certain houses and assets in certain areas of the market that are struggling while others are doing extremely well. So, it's a really interesting time. We've never seen anything like this. There's so much going on in terms of where valuations were. So even if a housing market corrects 30%, it doesn't really mean anything because the values were so overinflated to begin with. From a natural rate of appreciation, we saw 40% over the last couple of years. That's just not normal or natural in the housing market, nor were the interest rates. So the interest rates that we just experienced over the last few years, if you're new to real estate or new to investing, that's not normal. What's normal is 5 to 7%. That's a normal range for interest rates. And the only way you get below that threshold is with creative loans, interest only, buy downs, pay option arms, things like that, to buy that rate down. But that was not a normal time. So that's a very distorted view of the markets and of investments. And there's a lot of people that got in the markets over the last few years during, after the pandemic. And, all they've seen is just the markets just go parabolic and go up. So everybody thinks everything goes up.